Greetings everyone. Welcome to my channel XII Accountancy by Ch-1, Accounting Made Easy. Thank you for all the support that you all give me and for the wonderful comments. Keep showering your love on me just like this, and I'll keep making content for you all so that I can help you in your boards, in your exams, and whenever you want, I'll be there. Thank you. Moving on, today in this video, we'll be talking about Chapter 1 from Volume 2, Part A, T.S. Grewal, that is Accounting for Share Capital. And the topics which we'll cover is the issue of shares for cash, the terms of issue of shares which are at par and premium. We'll be talking about that with the help of an example. We have already talked about the meaning of share capital. What is share capital? It is the amount that the company receives from the issue of shares, which can be either equity shares or preference shares. We have also talked about the classification of share capital into authorized, the capital with which the company is registered, issued, that part which is issued for subscription, and subscribed, which has actually been subscribed by the public. So we have discussed all this in the previous video. For more details, you can click on the I button. Today in this video, we'll be talking about the issue of shares. Now, a company, it raises its capital. A company requires huge amounts of funds, and that funds are raised by the issue of shares. A public company can issue these shares only after it has met some legal compliances as per the law. As you have studied in business studies, that the issue of shares can be either a public issue or it can be a private placement of shares. I think you all are all well versed with these terms: public issue of shares and private placement of shares. So what is public issue? Public issue of shares means an offer which is made by the company to the public for the subscription of its shares. So it can be made by a public company after all the legal compliances have been complied with as per the law. So it is the offer made to the public for subscription of the shares. And private placement of shares means, it means when we are issuing and allocating the shares to a relatively small number of people, or to a selective group, or to certain group of investors privately in order to raise capital, and we are not offering the shares to the public in general through the public issue. So we are not making a public issue by offering to the public, but we are offering to a selective group of investors or small number of people, a group, so that the funds can be raised. So now talking about the issue of shares, a company can issue shares either for cash. That means you are issuing shares in return for cash, which comprises your share capital, or it can issue shares for consideration other than cash. For consideration other than cash means that whenever we purchase some asset, or we are purchasing a business, or we are taking up certain services, etc. So in return for the payment, instead of making a payment in cash, we are issuing our shares in the name of that vendor from whom asset or business has been purchased. Now these shares can also be issued to promoters. Now who are the promoters? They are those people who take up all the preliminary work for the formation of a company. So in return for their services, the company may issue certain shares to the promoters. Also, the shares may be issued to underwriters. Underwriters are those people who give guarantee to the effect that the shares will be subscribed by the public, and in case they are not subscribed by the public, then these underwriters, they give the guarantee of purchasing those shares that are unsubscribed. Okay, so in return for their services, again the company can issue shares to them. So shares can be issued for cash, for consideration other than cash, can be issued to promoters and to underwriters. We will be talking all about about all these four perspectives in detail, but today in this video we will be concentrating on issue of shares for cash. Okay, now issue of shares for cash, as I already told you, it means that the shares are issued by the company. Why are they issued? Because they want to receive certain amount. That amount may be received by check or a banking instrument. Now these shares which are issued for cash, they may either be issued at par or they may be issued at premium. We will be talking about the terms of issue in the after we talk about the accounting treatment. We'll be talking about par and premium. I'll explain it there. So Now, so the issue of shares for cash, we'll be talking about the accounting treatment for issue of shares for cash. But before we proceed to that, we should understand that the issue price is payable by the subscriber. I mean, issue of shares for cash can be done through two ways. The first is the lump sum method, and the second is the installment method. Now, what is the lump sum method? In the lump sum method, the whole face value of the, you know, share, the issue price, is payable with application. Okay, so for example, if I say there is one share at the rate of rupees 10 per share, that is 10 rupees is the face value. So this 10 rupees is called together, in a lump sum method, all this 10 rupees is together called up by the company. So the issue price is payable with application. Now you must be wondering, what is application? Now whenever the shares are issued, there are certain stages that are involved, which I'll be discussing in detail. Application, allotment, and calls. I'll be explaining all these three stages in the next slide, but now you just understand this much, that the face value or the nominal value of a share when called together by the company, that is referred to as lump sum method. And installment method means that when the issue price is payable in installments, that is the company having, the same company having one share at the rate of 10 per share. Okay, so that 10 rupees are not called up together, they may be called in installments. So as I told you, there are three stages: application, allotment, and call. So application, so say out of 10, 5 rupees may be called on application, 3 rupees on allotment, and 2 rupees on call. So instead of calling the whole 10 rupees together, we have split it into three installments: 5, 3, and 2. So that is the installment method, where the issue price is payable by the shareholders in installments. In contrast to lump sum method, where the issue price is payable along with application. So one stage only, and the whole 10 rupees is called by the company and is paid by the shareholder. Now let us understand these stages: application, allotment, and call. So as I told you that the nominal face value, what kind of stages are these? The nominal or the face value of a share, it can be called by the company in certain respective stages. Majorly there are three stages that are, in which the nominal face value may be called by the company. The first stage is application. Now what is application? Now, whenever the company wants to issue the shares, they will obviously, make an offer to the public for subscription. Now when the public wants to purchase the share of a particular company, what they will do is they will write an application to the, they will fill out a form and send an application to the company. Now the company, when it is making an offer, that time it is specifying the rate of application. Okay, so suppose for example I want to purchase some shares of a respective company. So what I'll do is I will go through the invitation, the offer made by the company, and there the application money would be written. Let's say out of 10, as I gave you an example, that out of the face value 10, 5 rupees are called on application. So if I want 100 shares of that company, that means 100 into 5, 500 rupees I will have to send along with the application. Application is basically I'm asking the company to allot me shares. So I'm asking the company to give me 100 shares, and when I ask that, I'm going to pay the application money to the company. Right now, according to section 39 subsection 2 of the Companies Act 2013, the minimum application money should be 5% of the nominal face value. So of the face value, 5% should be the minimum application money, or any amount as may be prescribed by Security Exchange Board of India. So SEBI prescribes that it should not be less than 25% of the issue price. So it should always be 25, not less than 25% of the issue price. So it depends upon the company. Between 5 and 25, they can, any amount they can choose. So what is application? The first stage, where the shareholder applies to the company, asks for the shares, and while asking, they pay the application money to the particular company. Okay, so now the second stage is allotment. Now in case of allotment, what happens is the company, see what example I took, that I had asked for 100 shares and at the rate of 5, since the application was at the rate of 5, so at the rate of 5, 500 rupees I had already paid to the company. Now comes the stage of allotment. Allotment means when the company is actually, allotting shares to the shareholders. The second installment is called as allotment, and it is the stage of allocation of shares where the company is actually allocating the shares to the respective shareholders. It is received from those shareholders to whom shares have been allotted by the company. So suppose allotment rate is at the rate of 3. Okay, so I had asked for 100 shares. If 100 shares are allotted to me, then I will pay allotment money at the rate of 300 into 3. Suppose if 100 shares are not allotted to me, out of 100 only 80 shares are allotted to me, then I will pay 80 into 3, and my remaining money, which extra money which I paid on application, that will be refunded back to me. So let's not go into those details. Simple, you should understand that application is the first stage, where the public applies for the shares. Allotment is the second stage where the company is actually allotting shares to the public. And now we come to the third stage, that is calls. So what is the next stage? Known as calls. Calls are made as provided in the article of association of the company. If the company does not have the article of association of its own, then it will take into consideration the table F of Companies Act 2013, and according to it, again, the call should not be more than 25% of the nominal face value. So the nominal face value 25% should not be more than 25%. What are we talking about? We are talking about the call. So calls can be made. So the example that I took was that out of the nominal face value 10, 5 was called on application, 3 was called on allotment, and 2 can be called on calls. Now these calls, again, they can be many calls. Okay, right? So let's say the company does not want to call 2 rupees together. It wants to call 2 rupees as 1 rupee on first call and 1 rupee on the second call. So the first call will be called as first call, share first call, and the second call would be called as share second, and final call. Whichever is the last call, you have to add this word final there. So broadly, there are 3 stages: application, allotment, and call. So there can be as many calls as the company wants, right? Now every we will be talking about the accounting treatment, but every stage, you should understand, has 2 entries. Okay, every stage will have how many entries? Will have 2 entries. We'll understand all these entries in detail in the next further slides. Okay, so these are the 3 stages in which the nominal face value may be called. Now one more thing that you have to understand is that I told you there are 2 methods: lump sum method and installment method. Right? Now in installment method, there can be application, allotment, and calls. These 3 stages minimum will be there. But in case of lump sum method, there will be only one stage, and that stage is, now you know that the first stage is application, but since it is just one stage, allotment has to be made, so it is called as application and allotment. So in case of lump sum method, there's just one stage which is called as application and allotment, and in installment method, there are 3 stages: application, allotment, and call. Now moving on, let's talk about the accounting treatment in case of these methods. First, we'll talk about the lump sum method. As I told you, in lump sum method, if the nominal value is 10, then the full nominal value is called together. There are no installments in case of lump sum method, and there is only one stage. There is only one stage in case of lump sum method, and we call it as application and allotment. Why are we calling it application and allotment? Because the public is applying also, and in the same stage we are allotting them shares also. So let's look at the journal entries. As I told you, every stage has 2 journal entries. Okay, let me just classify that for you. So as I told you, there will be 2 entries. Okay, one will be receiving entry. I'll be using this term again and again, and the other entry will be due entry. Okay, now since we are talking about the lump sum method, there is one stage only, as I told you, application and allotment, right? So since we are talking about application, so obviously the company does not know that how many people are going to apply. So obviously when people apply, first the company receives and then it becomes due. Obviously, because we don't know how many shareholders will apply, right? So after we receive the responses, then we make the entry for due. So the first entry would be bank account DR. Why bank account DR? Because we are receiving certain amount in for the issue of shares. So bank account will be debited to share application and allotment. Why are we receiving money? Because that's the first stage that's happening, share application and allotment. Money is the money that we are receiving, and this is known as the receiving entry. Okay, so first we pass the receiving entry denoted by R. As you don't have to denote it by R, just for making you understand, I'm just writing it like that. So first will be the receiving entry, and then we will pass the due entry. What will be the due entry? Now this stage, ultimately what's happening, we are receiving money from application and allotment, but what are we doing? We are issuing shares, and when we issue shares, the money goes to which account? It goes to share capital account. So this stage will be transferred to the share capital account eventually. So our entry will be share application and allotment account will be debited, because earlier it was credited, now we are just writing it off. So it will be debited and it will be transferred to the share capital account. Okay, so this is the entry. These are the two entries that we pass under lump sum method. So lump sum method, I'm repeating, it means the full nominal face value. Full nominal face value is called up together. Together 10 rupees अगर का share है तो 10 rupees ही हम इकट्ठा मंगवा रहे हैं. So that means that full nominal value is called up together, and in such a case there is just one stage, that is application and allotment. Every stage has two entries. One is for receiving and the other is for making it due. Making it due means transferring it to share capital account. So these are the entries that we'll pass in lump sum method. Okay, now let's talk about the installment method. In contrast to lump sum method, here the nominal face value, that is let's say rupees 10, is called in installments. Okay, and I just explained the stages to you. They are known as application, allotment and call. As I told you, every stage has two entries. That means two entries for application, two entries for allotment, and two entries for respectively howsoever many calls that we have. So every stage will have two entries. Now one more thing you have to remember: application, allotment and call. In application, I told you two entries. One will be the receiving entry, the other will be due. So in case of application, the first stage, we do not know what will be the response of the shareholders. That is why we pass the receiving entry first and then the due entry. But in the other stages, we know we've already got the response, right? So there first we'll make it due and then we will receive it. It means that making due means informing the shareholders that the rate of allotment is so and so. So first we are making it due. That means we are informing the shareholders that you have to pay allotment, let's say at the rate of 2. And then you receive the amount from the shareholders. And even in case of calls, first you'll make it due and then you'll receive. So only in case of application, first we'll pass the entry for receiving. Rest in all cases, first due and then receive. Now let's look at the journal entries. Since I've just taken an example where we have three stages: application, allotment and call. Okay, let's assume that there is only one share and the face value is 10 rupees per share. That is the face value, right? Application 5 rupees, allotment 3 rupees, call 2 rupees. I'm just talking about one share here. Okay, I'm sorry for this. I'm just talking about one share in this case. So our first entry would be, first we have to pass two entries for application. Okay, so first we'll receive the application. So we are passing the entry for receiving here. Bank to share application, 5 rupees we are receiving, since I've just taken an example of one share. So that means 5 rupees I'm receiving. Then we make it due. That means we transfer it to the share capital account again by rupees 5. So share application, whatever I done, one share into 5 rupees on application. Right, so first receive then due. But in case of allotment, what we'll do, first we will make it due and then we are going to receive it. So the allotment was at the rate of 3, so 1 share into 3. In the questions, obviously you will not have one share, you will have 10,000, 1,000, 1 lakh and so on. So number of shares will be multiplied by the rate of allotment, that is 3. So by 3 rupees I've passed this entry. First I've made it due, I've transferred to share capital and then I'm going to receive it. in the next entry. Again, in case of calls also, first I'll make it due and then I'm going to receive it. So share first and final call. Since I've taken just one call here, so I've used the word final here. Share first and final call account DR to share capital, and then bank to share first and final call account. So the call was at the rate of 2. So 1 into 2, 2 rupees will be your call, which will be due and which will be received. So as you can see, there were 3 stages. Every stage has 2 entries. So total, how many entries have we passed? We have passed 6 journal entries. 2 entries for each stage. But you have to remember that in case of application, first it is receive and then due. In case of allotment, it is due, then receive. And in case of calls also, it is first due and then receive. So this was the accounting treatment in case of installment method. Now moving on, let's talk about the terms of issue of shares. Now the shares which are issued for cash or for consideration other than cash or to promoters or to underwriters, the shares may be issued either at par or they may be issued at premium. Now what is at par and what is at premium? At par means where the issue price is equal to the nominal face value. Suppose if the nominal face value is 10 and that share I have issued for rupees 10. So my nominal face value is equal to my issue price. A share of rupees 10 issued at rupees 10 means it is issued at par. But at premium means where the share of rupees 10 is issued at more than the nominal face value. Let's say it is issued at 12. So what is this 2 rupees? This 2 rupees is the value of premium. Premium means the amount over and above the nominal face value at which the shares have been issued. So issue of shares can be either at par or it can be at premium. Section 53 of the Companies Act 2013, 53 section of Companies Act 2013, it does not allow the issue of shares at discount. Right, so it is allowed only in case of sweat equity shares. We'll be talking about that later, but issue of shares at discount is not there, neither it is in your syllabus, and it is only at par and at premium. When nominal value is equal to issue price, it is at par. When it is more, issue price is more than the nominal value, then it means it is at premium. Now in the entries that we just learned, bank to, in case of lump sum method, since there is only one stage, application and allotment, as I just explained to you. So bank to share application and allotment, share application and allotment to share capital. This was the entry that we learned. In case there is premium, in case there is premium, in such case premium is always shown in the due entry. It is always shown in the due entry. So in the entry, when we are making the due entry, there we will show security premium reserve. Suppose if there was a share, one share at the rate of 10 per share and premium plus premium was at the rate of, let's say, 2. Okay, so how will we show it? When we are receiving, people will pay us 10 rupees also and 2 rupees also. So 1 into 12 along with premium I'm going to receive. So 12 rupees I'll show here, and in the next entry, due entry, in share capital always the face value is shown. So face value is multiplied by the number of shares. So number of shares as I've taken 1 and face value is how much? It is 10. So in share capital I am showing here 10 rupees. In security premium reserve, 1 share at the rate of 2. So 2 rupees here, and share application and allotment will be 12 as we had shown in the previous entry. So when we are receiving, we'll receive the full value, but in share capital we will show only the nominal value and SPR will be credited with the amount of premium. Similarly, in the installment method, again the premium may be on the application stage or allotment stage or call stage. It can be on any one of the stage. So depending upon where it is given, if it is on application, then in the application due entry we are going to credit it. If it is on allotment, then allotment due entry we are going to credit it, and if it is on calls, then call due entry we are going to credit it. So respectively, the premium, whichever stage the premium is on, we are going to credit it in the due entry, but it will be included in the bank amount, obviously. So let us understand this. One more thing, that in case the premium is given and it is not mentioned it is on which stage, then we will always assume that premium is on the stage of allotment. If nothing is given, we will assume that premium is on allotment. Then in allotment due entry, we are going to show it. Now let's understand this with the help of an example. So this is an example that I've taken. New India Limited was registered with a capital of rupees. Now it's very important to note here that the term this symbol rupee symbol is here. So these are not the number of shares. This is the total registered capital. Okay, so in equity shares of 100 each. So what can I do is I can divide this registered capital by the number of shares. So what will I get? Now how many zeros are there? 3. 1, 2, 3, 4, 5. Sorry, 1 lakh. So 1 lakh will be the number of shares. So number of equity shares is how much? 1 lakh, right? So it issued a prospectus. Inviting applications for 20,000 shares. So 1 lakh was the registered capital. The number of shares with which the company is registered. Out of this 1 lakh, only 20,000 shares are offered to the public for subscription. Inviting applications means this is the issued capital. At 40% premium payable as follows. Now what is 40% premium? That means premium will be equal to the face value is 100. 100 into 40 upon 100 will be equal to how much? 40. So that means the face value is 100 and the premium is 40. So 100 plus 40, the shares were issued at 140. Now it is given payable as follows. On application 50 including 10 rupees premium. 50 including premium. That means I'm just going to split it here. That means my application was 40. Okay. And my premium is 10 rupees. Right. On allotment 40 including premium. That means my allotment is at the rate of 30 and premium is at the rate of 10. First call 30 including premium. That means first call is at the rate of 20 and premium is at the rate of 10. And on second call 20 including premium, that means my second call is 10 plus 10 rupees premium. Now just make a total of all this so that to ensure that we have done correctly. 40, 30, 70, 80, 90, 100. That means our face value is 100 and 10, 10, 10, 10. That means 40 rupees is the premium. Shares was subscribed and the amount was duly received. That means all the shares which you had issued, they were subscribed for and you have received all the amount. What journal entries would you pass and how will you show it in the balance sheet of the company? Now, how many stages are there? First of all, identify the stages. So, application, allotment, first call, and second call. 4 stages into 2 entries. So how many entries we have to make? 4 twos are 8. So there will be a total of 8 entries, 8 journal entries that we are required to pass. Now we are not concerned when we are making journal entries. We are not concerned with this 1 lakh, the registered amount number of shares. We are only concerned with the issued thing. So we have issued 20,000 shares at the rate of this, what we have written here. So let me tell you that what journal entries would be passed. But before we move on to the journal entries, I would request you all to take a screenshot of this so that in case you want to refer back to the question, you can do that. So moving on, the first entry would be for application. As I told you that in case of application, first we pass the receiving entry and then we pass the due entry. So our first entry will be bank account dr to share application and our second entry would be share application to share capital to security premium reserve. I am going to write to security premium reserve in all the stages. Why? Because on every stage premium was given. Now in the first stage it was written 50 including premium. So my stage was, I'll just write it here for you. Yeah, I'll write it here for you. My first stage was on application 50 including 10 rupees premium. So my stage was 40 plus 10 premium. I'm just going to write it here so that you remember what were the amounts. Now the number of shares were how much? 20,000. So 20,000, that is the number of shares, multiply by the total amount 50 gives you 10 lakh. Right, and in case of the second entry, share application will have the same amount 10 lakh. In share capital you will multiply the number of shares by the face value. What was the face value? That was 40, not the full face value, but that is I'm talking about the rate of application. So 20,000 into 40 and what will be the premium? 20,000 into 10. that is 2 lakh. So 10 lakh, 8 lakh, 2 lakh, right? The number of shares are multiplied by the amount of premium, by the amount of the rate of application, and then with the total we are showing in bank. Now we come to the allotment stage. First we'll pass the due entry and then the receiving entry, because on allotment also we have premium. So again premium will be credited in the due entry for allotment. How can we calculate the amounts here? Again, number of shares are 20,000 into, now what was the rate of allotment? It was given to us that on allotment 40 including 10 premium, so that is 30 plus 10 premium, total is 40. So 20,000 into 40 gives us 8 lakh. Share capital 20,000 into the actual rate of allotment, that is 30, gives us 6 lakh, and then 20,000 into the rate of premium, that is 2 lakh, right? So first we'll when we are talking about allotment, we'll multiply by the allotment rate, that is 30. Sorry, yes, that is 40 total amount, and in share capital we will multiply by the rate of allotment. In the bank entry, simply the share allotment was debited with 8 lakh, so that is what is the amount that we are going to receive. So directly I have written, I don't need to calculate it again. Whatever is the amount that has been debited to share allotment will be the amount that we are going to receive. Now we come to the next stage, that is the first call. Again, the due entry first and then the receive entry. Now in case of first call, it was written on first call 30 including 10 premium, so that is 20 plus 10 premium, total value is 30. So again, first will be the due entry where security premium reserve will also be shown, and second will be the receiving entry. Again, the number of shares are 20,000 into the total amount was 30, so into 30, that is 6 lakh. In share capital we will multiply by the respective rate of first call, that is into 20, which is 4 lakh, and premium is at the rate of 10, so 20,000 into 10, that is 2 lakh. Then receiving may, I don't need to calculate again. I made the due entry with 6 lakh, so I'm going to receive 6 lakh. Now we come to the last stage. Again we'll pass the due entry first and then the receiving entry. The second call was for 20 including premium, so that is 10 plus 10 premium, total is 20. So 20,000 into the total amount 20 is 4 lakh. 20,000 into the rate of second call, that is 10, and 20,000 into the rate of premium for the first and final call, that is 10. We get the respective amounts and then we pass the entry for receiving. We had made the due entry with 4 lakh, so we are going to receive 4 lakh. So as you can see, there were 4 stages: 1, 2, 3 and 4: application, allotment, first call and second and final call, and there were 2 entries each. In case of application, receive then due. In case of other stages, first due and then received. Also premium was given on every stage, so on every stage premium has been credited and it has been received. Moving on, let's see how it will be shown in the balance sheet. Balance sheet format you already know. Share capital is shown under shareholders fund under equity and liability part of the balance sheet, but before we make that, we need to make the notes to accounts. In the notes to accounts, whether information is given or not given, we need to prepare authorized capital, issued capital and subscribed capital. We have to write all that here. So authorized capital, it was given 1 lakh equity shares at the rate of 100 each, that is 1 crore, that is only for information. Again, issued capital, it was given that the company issued 20,000 equity shares, that's 20 lakh, only for information. Now we come to the subscribed capital. Subscribed capital may we'll show subscribed and fully paid up. Why? Because it was mentioned in the question. The company had called full face value and it has received full amount from the shareholders. So total 20,000 shares at the rate of 100 each. So 20 lakh would be your subscribed capital, and this 20 lakh will be shown in the share capital under the equity and liability part of the balance sheet. This is how we are going to show it in the balance sheet. I hope the concept is clear and I hope all the journal entries are clear. We have talked about in this video about share capital, the issue of shares for cash, how they can be issued at par and at premium, and we've taken a like full-fledged example for explaining the same. I hope the concepts are clear to you. Thank you so much for being so patient and listening to me intently. I hope this really helps. If you have any questions, you can contact me on my email ID or you can leave a comment below in the comment section. I'll be more than happy to revert back to you. Please like, share and subscribe to my channel. Pass it on to as many as possible so that it reaches those who might be in need. So thank you so much. This is Inside Accountancy by Shakun signing off. Thank you.